Hello everyone, this is Bella. Welcome to my new teaching video on technical analysis. Welcome to my new teaching video on technology analysis. Today we're going to continue our research and discussion around the moving band, trend pullback band trading system that we designed, and we're going to start this video with a review of what you need to be aware of when you're using this system, and what you need to be aware of when you're doing any type of trading. The direction in which the first moving averages diverge is the direction in which the trend of the current cycle is moving, which is the direction of least resistance to price movement at the current level. The trend is our most reliable partner in the market. Traders only trade in the trend direction, and do not consider any trades against the direction of the moving averages until they have proven that they can make steady profits. The second is to trade when the market is clear. If you look at this chart, although this strong rally has put the moving averages in a bullish divergence pattern, it is also clear that the rally has not broken the previous band highs and the overall market backdrop is in a range, which is not the trend we like to see. Even though in hindsight it would have paid off for us to participate in the multi-deal, we shouldn't have participated in it because the deal wasn't good enough. Now if you look at this chart, it's very clear that this is a very clear trend compared to what we just saw. And if we're looking at this kind of market backdrop, it's going to be a very strong trade. We have talked many times about the importance of the entrance signal, K line. It is true that some forms can easily reach the stop position without the confirmation of the entrance signal, but most of the transactions where you rush to enter will trap you in a form that you should not enter. At the beginning of trading, you can only master some simple entry signals. With the accumulation of educational experience and learning more and more in-depth trading techniques, you can master more advanced entry confirmation signals to make your trading entry more advantageous. But this step cannot be achieved overnight, only on their own. Slowly practice, gradually understand. There are patterns where the first sign of strength shows up and you hit your stop loss, but then you give a better shape or a better second entry and logically you can get back into the market. But if the market rejects me the second time around, it's time to think about whether the market has changed or whether I'm out of sync with the market or whether I'm just having bad luck or whether I should take a break and stop trading. I read in the comments section about a friend who came in at the same price and got stopped and came in and got stopped and went back and forth 10 times and blew up his account, and that's a typical market price that didn't change and he lost his account, and we've all been there at one point or another. What I recommend is that you take a stop loss once or twice in a trading opportunity, you close the price chart, you take a walk, you relax, and then you go back to trading. At this point in time the market is open for you to trade, and you can trade now, tomorrow, months from now, years from now, decades from now. You can open the chart and trade. There is no shortage of trading opportunities in the market and you have to keep that in mind. Okay, so that's all we're going to talk about, and then we're going to talk about how we can improve the profitability of this system, and now we're going to talk a little bit about some examples of systems that we've been using to get a chart, and we're going to look at the overall market background. The average group, the short trend, and there's a continuous push to verify that the price behavior is also a healthy short trend and the market background is conducive to participation in short orders. Look again at the details and look for entry patterns and confirmation signals. First, there was a strong short breakout and now it's a simple pullback. Take a closer look at this pullback, and I've indicated with my arrows the change in the upward slope from the strong to the strong. This is where the first short breakout occurred and the short tried and failed to regain control. There is no entry signal given to us, there is no return to the dynamic resistance zone, there is no retreat to the breaking point, and there is no strong entry signal where a friend in a hurry to enter will be trapped. After a brief correction, the bulls are back in action, but we know that the overall market backdrop is favorable to the bears and most bull reversal attempts will fail, providing us with the best opportunity to ride the tide. If you look at the K line at the arrow, it's not a good inverse K line because even though it has a long upper line, it's not a big bull entity, but we do know that it's a second shot for the bull, and if the low of the K line is broken it means that the bull has failed 2 attempts and it triggers the second break that we usually use. In addition, the price has now measured back to the dynamic resistance area provided by our moving average group and has also measured back to the previous breakout point, which satisfies our entry price requirements, so we can now set the breakout order entry, stop loss, stop profit targets, which are all indicated on the chart. The logic of setting has been explained many times, and I won't repeat it here. If you look at what happens, then the next K triggers our entry order here, but unfortunately, it yields a small drop entity, K line, with a long line. What we expected was that the bulls would give up resistance to the bears and come back in and take control on the way down, and clearly the market is dismissing our expectation that the next K is a strong bull trend K line and a few more Ks and our stop loss is knocked out, and it's not a comfortable feeling to have the market deny what looks like a decent entry condition, but this is the way the market is, and we have to live with it. And we don't have to feel bad about it. Just to review the overall market context, it's a very long and healthy trend, which means that if you were to trade strictly with this system, you should have at least 1 or 2 completely closed trades. It's okay to lose a little bit now that the trend is probably over, or it's going to be a complicated correction. The trend has already made a good profit, and if you're a little more skilled, the trend will have at least 3 or 5 good entry patterns, and the last stop loss won't matter to you at all. You might look at a stop loss and say, oh, maybe the trend is over, so I'll take my money and I'll take a break and I'll come back and trade. It's easy, because the way we do this system is based on the power of the trend. The power of the trend is very strong, but there's always a point where it reverses, and in order to make the stop loss less painful, we have to pocket the money that we have to make in our system. If you mess around and you don't make the money you should make, the stop loss, you should eat it as a serious blow to the trading mentality, and we should try to avoid this kind of thing. Let's take a look at the next 1-hour chart of the Canadian dollar versus the Japanese yen. This is a case of convergent form breakout entry. I almost never trade form breakout, so I'm not going to use the K-line playback function to go into the details of the form breakout entry. You can go back to my video on breakout. The intermodulation form is also a convergent arrangement that most of you are familiar with, and you just have to break through the entry for this form. This example is very simple, and you get TP1 and whether you can get TP2 with a high profit/loss ratio. Depending on how adept you are at breaking patterns, I like to use the K-line to enter. This pullback doesn't give us a good entry when we look at the price test the first pullback high, which is when this rally is testing this little high. What he did was he made 2 heavily overlapping K-lines, and the second one was a non-trend K-line with long up and down lines, and obviously this was not an entry signal in our system. Then look at the third push-up and retest that level, and in hindsight you do find an opportunity for a second breakout short entry, but for me, it's not a strong enough signal to have the false breakout that I like to see. So it seems to me that even though I know that there's a good chance that there's going to be a down period, I'm not going to be able to take advantage of that, and it's a very common situation for traders that even though you know that the market as a whole is going to move in a certain direction, that doesn't give you an entry signal in your system or an opportunity pay period in your system, it can be very difficult to accept that kind of psychological drop. However, as you gain experience in trading, you will realize that the more you try to seize every trading opportunity, the more likely it is that every trade will fail. It is easier and more efficient to just do the trades that you are good at in your system and ultimately achieve a good level of return. Moving on to the Japanese yen, at any point in time, you can see that most of the K-lines in the chart are accompanied by very long shadows. This is a phenomenon that occurs in many cross charts in the foreign exchange market. It may be due to lack of depth, or it may be due to other factors that I haven't studied in detail, so I never make crosses. The point I want to make is that a chart like this, with a lot of burr on the K-line, is bad for price behavior, because we need to look at the solid and shadow of the K-line to interpret market sentiment. If you like to trade charts, and this happens a lot, I would suggest you change the cycle, and if you're doing a variety that has this kind of price performance every cycle, then I would suggest you do a variety that's a little bit deeper, and of course that doesn't mean that we can't do technical analysis with this kind of chart. It just requires a stronger entry logic to take part in the trade. If you look at this example, the left is a 2-hour chart of the Aussie versus the US dollar, and the right is an 8-hour chart of the Aussie versus the US dollar. The time horizon of these two charts is about the same. We can see that the strong short trend in the 2-hour period is also the strong short trend in the 8-hour period, so this is what you call a paradise market. And if you're looking for patterns in the mini-cycle chart and you're participating in the trend direction trade, it's a huge advantage, and there's very little time in the actual trade that the market is in this beautiful trend state. And that's exactly the kind of market that has the most potential to make money, and if it happens. But most participants are going to let that happen, and they're going to lose because they don't want to buy in. They're going to look at the market and they're going to think that the trend has been going on for so long that it's time to reverse. They're going to be afraid to buy in, and smart players, knowing that the trend is likely to continue as long as there's no obvious downside to it, look for any reason to get in on the bandwagon. What's the premise of a trend reversal, and we've talked about this many times, is that the weak performance in the trend direction plus the successful breakout against the trend, the weak performance including the false breakout and the high tide movement first has a complex pullback, and then the trend continues without the weak breakout against the trend, and then the successful breakout against the trend can reverse. When there are these signals, smart players will be cautious about their trend positions and even get out of the market. Most friends are probably most familiar with the Bitcoin day cycle strong trend. We've done a lot of cases with this graph, and you can go back and look at it yourself and see in this strong diurnal trend what you can find in the small period chart with our moving average system that we've been talking about, the big and small periods. And now let's look at some examples of the big and small periods going against each other. And on the left we have a 2-hour plot of the Australian dollar versus the Canadian dollar. The EMA group has just seen a divergence of bulls, and the price has broken out of the previous band point, and now it has retreated to the dynamic support area of the EMA group to gain support and try to continue to push the bulls. Now on the right-hand side, when the time is switched to 8 hours, the EMA chart also shows a good short trend alignment, which means that the market conditions in the big and small cycles are out of sync. Which direction are we going to go in? In general, small cycles are subject to large trends, but all reversals start with small cycles. It's easy to understand. Small cycles are subject to large trends. I don't need to say much about the second half. All reversals start with small cycles. To continue with the case of the Bitcoin daily trend, if you don't understand it, you can try to see it yourself. You open the daily 12-hour, 4-hour, 1-hour chart one by one and mark the point at which the trend reverses in the moving average group of each period. Each time period has its corresponding energy. The big cycle trend reversals usually have to run out of energy in the small scale areas first, except for the high tide reversals. If the big cycle has a high tide reversal, then all the small scale trends have already gone into overdrive. Now that we know the relationship between the big and small cycles, we're better off going with the big and small cycles. If the big and small cycles go against each other and the small cycle appears logical entry opportunity, that can be done, but strictly in accordance with the small cycle. To stop losses, carefully manage the order trend from the cycle you participate in. A step-by-step reversal is not impossible if the size of the cycle is contradictory and there is a logical entry signal. It is best to choose the big cycle. Participation will be higher. There's a little question. We say that the big and the small cycles are great trading opportunities, but when you look at how many times the cycle, the two cases I'm using are 2 hours and 8 hours, which is 4 times compliance. Does that have to be the case? Of course not. When the teacher talked about Vegas system before, he liked to use the principle of 4 times compliance, so I just used it casually. In the actual transaction, it is difficult to meet the market resonance of 4 times cycle trend. I think it is worth participating in as long as the transaction of 2 times cycle compliance is satisfied, such as 5 minutes and 15 minutes, 1 hour and 2 hours are both comfortable cycle combinations. But the reason we're learning price behavior analysis is to get rid of these messy indicators and focus on the market and do simple trades and not try to do the weak period combinations and focus on the current chart. And there's nothing wrong with that except for the fact that if you're a beginner, you're going to make a lot less mistakes with these weak period constraints. Now let's move on to the last question. Assuming that you've practiced our trend pullback trading system for the last 6 months and become so proficient that you can reach the average profit level of the system, How do you continue to increase your profitability? So let's talk a little bit about using a system proficiently. You have to be able to use the tools in the system to quickly and accurately read the charts and find the patterns and signals of your trades and all kinds of things without the signals in the system, and wait and not be blind once an opportunity arises to move in decisively. No fear of the unknown market during your position, no anxiety to stop your losses. The lack of pride doesn't carry over the emotion of the last trade into the next trade, and you can't even think about improving your profitability until you get to that point where you should be practicing your execution. Until you think about improving your profitability. I'm sure the first reaction of many of you is to add multiple types of trading opportunities. For example, our system mainly deals with trend pullbacks. So if I add trend-breaking range trading and even reversal trading, I will have more trading opportunities. It's definitely easier to make money, and that's a big misconception when you think about how fast it can take you months to 6 months to finally master the trend pullback trade and make a steady profit. Why bother practicing patterns and entry signals that you're not good at? This kind of chaos is likely to greatly reduce the efficiency of your system's execution. It may be that the easiest way to improve is to find more trading opportunities within the system or to increase your position. Let's explain that finding more trading opportunities within the system is not at all the same as adding more types of trading opportunities. So if you're comfortable with this trend pullback trading system and you turn on your computer every day and you resend a variety, and it should take less than 5 minutes to go through the cycle and scan it for potential trading opportunities, then you can add to the variety library and then look at the weekly related individual varieties and look for opportunities in your system. It's really easy to focus on 5 or 10 species at a time with our system based on the average group, and it's really easy for me to focus on 20 or 30 species at the same time. Increasing trading opportunities to increase profit, and we've already talked about the logic behind that in the previous videos, and now let's just talk a little bit more about it. So let's say that if you implement this system and you can do 0.5, the expected value of the system means that on average you can make 0.5 stop loss per trade, and at your current risk tolerance you can take on $1,000 per trade. So that means that on average you can make $500 per trade. You used to be able to focus on 3 or 4 varieties, and on average you could do 15 trades per month, which means you could make $7,500 per month on average. But now as you become more proficient you can focus on 10 varieties, and you can find 30 trades per month within the system. I don't need to tell you how easy it is to make $15,000 a month on average if you keep your position the same, and you can easily double your profit by expanding your trading position to increase your profit. The thrill of making a big profit is something every trader has experienced. Let me just say a few key things to note here. You can't increase your trading position until you have increased your account principal to a new size or your trading skills have improved significantly. For example, let's say you used to have a $1,000 stop loss per trade, and now you have doubled your account and you feel that this is too easy a risk. It's okay to increase your position to $1,500 or even $2,000 per trade. Your account balance is a proof of your education. Now, one of the things that comes to mind for those of you who have seen this video is that a trading position is the amount of money you can stop losing and not the amount of money you can stop losing. So for example, if you're trading gold, let's say you used to open a $10 stop losing space every time you open a hand, and the amount of money you can stop losing is $1,000, and now you have to increase your position. It's not like you're going to make it $20. You're going to double the number of hands, and you're going to make it $2,000 per trade. Another way to think about it is to increase the overall level of participation in the system. So let's say you start trading at 1% of your stop-loss account as a practice, but now that you've gotten so good at it, you can increase your stop-loss to 2% of your account and then to 3% as you get more skilled. The risk level of this approach is much higher than the previous approach, and the return growth is much greater, and you can only choose if you have a clear improvement in your trading level. Okay, so we've covered most of the tools and technical ideas that you need to make a trade, and I'm going to focus on some of the bits and pieces in future videos. So if you're doing it from the beginning to the end, you can start doing it right now with a very small amount of intraday trading to get a feel for the market, and just watch the videos and read the books, and everything you've learned is very theoretical. Only by practicing Can you deeply feel the uncertainty of the price movement? And then you can use the knowledge you have learned to deal with various market conditions. After accumulating enough experience, you will build up your own perception system and coping strategy of the market and slowly live the life you want by trading. Remember that the road to trading is a long and lonely journey, and the rush to success will only kill you. That's all for today. Thank you for watching.